So thank you for joining us today in our, I was going to joke, 450th JobKeeper webinar, but I think we're only in double figures. But thank you. My name is Bruce McFarlane. I'm the CEO of the Blue Rock Group, and I'm also the Managing Director of Blue Rock Law. For those of you who haven't been part of our webinar series and haven't been part of the Blue Rock community before, we're an entrepreneurial advisory firm. We've got two parts to our business. We've got a professional services part with accounting, law, wealth management, finance, digital, insurance, and along with a number of other businesses. We've also got an investment part of our business where we own and co-operate a number of businesses in hospitality, property, technology, retail, and a number of other areas. And so what that means is that we've been along on the COVID-19 journey for some time, from back in March when we had a coronavirus case in our office. And so we all had to move out of our office. And also we had to work with a number of our clients that were shutting down their businesses because they weren't allowed to operate. So we're very much across what's been going on, both as business owners, but also as advisors to our clients. As you're probably aware, the government have been very supportive and released a number of different packages for businesses over the last 6 months. And with JobKeeper that we're going to talk about today, there were some new rules on the extension bill that came out last week. So we'll go through those in detail for everyone. And particularly, thank you to the people that have been part of these webinars over the journey. So today there'll be a lot of discussion around what happened last week, as well as an update on some of the legal implications of those. But our panelists today, so Joe McCartney is an Associate Director of our Blue Rock Accounting, so welcome to Joe. And Lisa Marie Parks is a Senior Associate in the law firm, so welcome Lisa. The logistics, as Rosie mentioned, for those that were on when she started the webinar, we will be recording the session. We've turned off the chat function, but we've got the Q&A function working, and we are very happy to take questions along the way through. So send the questions through and I'll try and get to them whilst Joe and Lisa are speaking. But if I don't, the questions will be answered whilst the other person's speaking. So fire the questions through. Joe, we're not going to start with JobKeeper. So today, we'll talk about some of the other grants. So there's been a few grants released by different levels of government over the last few weeks. So do you want to run through some of those?
Yeah, so just to touch on some of the really recent ones that have come out. So the Victorian Government Business Support Fund 3, so good to see they're getting really creative with their names now, is now open until the 23rd of November. So it's really tailored and limited to the industries with a restriction level of restricted, heavily restricted or closed, and is not easing restriction levels between the first and second step of Vic's roadmap for reopening. So the criteria for this one obviously must be in one of those industries, and that you must be on JobKeeper, be registered with WorkSafe, have a payroll of less than 10 mil for financial year 2020, registered for GST and have an ABN. There's 3 levels of the grant funding. So it's a $10,000 grant if the annual payroll is less than $650,000, $15,000 if the payroll is between $650,000 and less than 3 mil. And the last one is it's $20,000 if your annual payroll is between 3 mil and up to 10 mil. It also excludes those receiving funding under the licensed hospitality venue fund. So they're getting funding in an alternative manner, so you don't get both for this one. Another one the New South Wales government have put out is the Southern Border Small Business Support Grant. So that's really for those towns that are the border towns. So Itchika-Moama, Albury-Wodonga, those sort of ones. So for that one, you need to have an ABN registered in an eligible local government area. So there's a list of the local government areas that this applies to. You have to have Australian wages below the New South Wales government 2020 threshold for payroll tax of $900,000 and have an annual turnover of more than $75,000. So there's 2 levels again for the grant. So to be eligible for a $5,000 grant, you must be or you can be a non-employing business, so you include sole traders, or employ fewer than 20 full-time equivalents. have to have a decline in turnover of at least 30%. The other one is the $10,000 grant, and that's for those that have got at least 0.5 full-time equivalent workers, but fewer than 20, and have experienced a decline in turnover of at least 75%. So we'd also suggest checking with your local council, because they're also putting out a lot of grants. So I'm aware City of Banyule is one that's put some out, and City of Melbourne have had some previously. So just jump on to your local website as well and just double check if there's anything in your area.
There's council elections on at the moment. There's probably a few things in policies in place. So sole traders haven't received as much support as they probably would have liked. Is there anything available for sole traders?
There's not a lot, to be honest. There's one that's going to be opening up in the coming days, and that is the Sole Trader Support Fund. So that one will be a $3,000 grant for non-employing people operating in an industry sector that has been heavily restricted or closed as a result of the continued restrictions, and you have to be on JobKeeper. The other big catch that comes with this one is that you need to operate from a commercial premises. So I think that potentially is going to rule out quite a lot of the sole traders, unfortunately.
Okay. Well, if anyone's got any questions about any of the other grants that are available at the moment, yeah, feel free to shoot them through. But we might move straight to JobKeeper because there's a lot to get through tonight. So JobKeeper 2.0, so how does the business turnover test work now?
So unfortunately, we're still waiting on the Commissioner to release the rules regarding the alternate tests. What they've said is that you will need to advise the ATO which test you're using, whether that's an alternate or the basic test. But yeah, I was really hoping that we would have had that information by today, but we are still waiting on that part. So the only one that we've got at the moment is the basic test, and there's 2 basic tests that the business must pass. So there's the standard required drop in turnover tests haven't changed. So they're the 50% for those with an aggregated turnover of less than $1 billion, 30% for those with an aggregated turnover of $1 billion or less, and 15% for charities and not-for-profits. So the original declining turnover test required, and this one, if you've already been on JobKeeper, you don't need to worry about this because you will have already passed it. But if you're a new entrant, say from the 28th of September, you need to forecast a drop in turnover for a calendar month or quarter that ends prior to the 1st of January 2021. So there is still that you need to forecast an expected drop. The second test is the new declining turnover test. And the first one covers the period, your eligibility of the 28th of September through to the 3rd of January. And that requires an actual turnover decline for this September quarter compared to September quarter 2019. The second period is the 3rd of January through to the 28th of March. And that requires an actual decline in turnover for the December 2020 quarter compared to the December 2019 quarter.
Okay. I'm going to change tack just for a sec, Jo. There's a couple of questions on the sole trader test, so I'll jump back to that for a minute before we move on. But so Bob sent a question through that he's a sole trader and working in a commercial premises. So he's had 10% income for the last few months. Can he apply for both the grants?
So with the first one that I went through, which is the Government Business Support Fund 3, that is only for people that have got employees.
Yeah.
So unfortunately, if you're not an employing sole trader, you won't be eligible for that one, which is why they've then put in this second one for the sole traders.
Yep. And so another question around the sole trader requirements, is it out of a commercial property? Is that based on the registered business address?
I'd need to double check on that one. I think that probably is the case. It'll be where the ABN is registered, which is also how they're checking for that fund number 3. they're checking what is the industry code on that's registered with your ABN. So it might be a case that people do need to update that, but I think those two are then going to be how they're going to check it.
Yeah, and Bob's just saying he does have employees, so
cool. If you do have employees, then you should be right to apply for the support fund number 3, but you won't be able to apply for the sole trader one, because the sole trader one is only if you are not employing people. But yeah, if you're employing people, then you should be right for that first one.
cool. We might go back a step then. So with JobKeeper, we're going to refer to JobKeeper 1.0 and JobKeeper 2.0. And so just to be clear, so we might just, the dates that are applicable for the different JobKeeper schemes. So JobKeeper, the first one, so the businesses that were in JobKeeper was March the 1st.
Yeah, so the JobKeeper fortnights were the 30th of March, and that finishes on the 27th of September, which is this Sunday. Yep. So that's that period we're referring to as JobKeeper 1.0.
Yeah, and so this, so that's the finish date for the September quarter. Is this one? Yeah. Okay.
Yeah.
No problem. Rightio. Well, we might just move on for the next question around the turnover definition. So, have there been any changes to what turnover means for JobKeeper?
Yeah, that's right. So for JobKeeper 2.0, it's based on your actual GST turnover, and there's a couple of little quirks to that. So as with JobKeeper 1.0, you exclude input tax suppliers and any suppliers that are not connected with Australia. This is where then the quirks come in. So unfortunately, there's no adjustment for bad debts. So say, for example, in September 2019, you raised a $1 million invoice, and that was unfortunately then written off as a bad debt during the year. You don't get to adjust for that. So the turnover September is still that $1 million, not the net of the bad debt. And the other quirk is that it will also include the sale of capital assets. So, for example, clients leading up to the end of financial year might have been selling off equipment in order to purchase new ones for the instant asset write-offs, that sort of thing. That all comes into your GST turnover. So it's a bit of a tricky one in that it's not really related to normal turnover, but it does get included for the purposes of the test for 2.0.
And does it matter whether you use the cash or accruals method of determining your turnover?
Yeah, so it's a lot more restricted than JobKeeper 1.0, where you really did have an option between the two. For 2.0, it's pretty much what your BAS is registered as. If the entity is unregistered for GST, you can choose to use either cash or accruals. If you've always been registered for GST and you haven't changed between cash and accruals, you need to go with what you've been using the whole time. And then if any of the following scenarios apply, you need to use the original accounting base that was in the comparison period. So if you were registered for GST at the beginning of the comparison period, if you became registered for GST during the period, or you changed accounting basis, so say in the first comparison period, we're looking at September 2019. If you were on cash then, and since then you've changed to accruals, you need to use cash. If you were originally on accruals and changed to cash, you need to use accruals. So it's really not a lot of choice this time around.
Okay. So the turnover definition, just to clarify, the supplies that aren't connected with Australia aren't included. So
That's right.
Sales overseas not included.
That's right.
Okay. And so a question from Stuart there. So the actual dates for the qualifying period, is it ending on the 27th of September?
That's the end of the fortnights for JobKeeper 1.0.
Yeah.
Yeah.
So so if you don't qualify for JobKeeper 2.0, yes, that's the end.
That's the end.
But if you do qualify for JobKeeper 2.0, then you've just got the next fortnight period starting from
which kicks off on Monday. Yeah, that's right. One thing to note with those with the fortnights is previously we've had to make the payments for the relevant fortnight in those fortnights. They've given a little bit of discretion for this next one. So for the first 2 JobKeeper fortnights in JobKeeper 2.0, you don't have to make the payments to the employees until the 31st of October. But then after that, it does go back to the payments have to be received by the employer in each individual JobKeeper fortnight.
Okay. So just got a clarification point around that overseas sales. So is it, so export sales are not included?
That's correct.
Correct. Yeah. Okay. So just moving on to the rates now. So in JobKeeper 2.0, there's a few different payment rates. So how do they all work?
Yeah, so one of the quirks with the initial JobKeeper 1.0 was that everyone received that flat 1,500 regardless of how many hours they actually worked. So it resulted in some people receiving more than what they would ordinarily work. So what they've done for JobKeeper 2.0 is split it between pretty much the December quarter and the March quarter. And if the employee or the sole trader or eligible business participant worked for 80 hours or more in the reference period, they receive the higher rate for the December quarter, which is the 1,200 per fortnight. And then if they did less than the 80 hours, it would be that they only received the 750 a fortnight. Then we move to the March quarter, which begins on the 4th of January. And if the person has done more than 80 hours, then they receive $1,000. So they've gone from the 1,500 to the 1,200 to the $1,000. If they've done less than the 80 hours in the reference period, they'll receive the 650 a fortnight. So those people have gone from the 1,500 to the 750 to the 650.
Okay. So the eligible business participants need to complete a written declaration to say that they've worked 80 hours or more or less than 80 hours. Is that how it works?
Yes, that's correct. Yeah.
Okay. So there's 2 rates for employees. So how do they work?
Yeah. So the part that we're looking at is whether they worked 80 hours or 80 hours or more or less in what they're calling the reference period. And that 80 hours includes actual hours worked and any hours for which the employees received paid leave, including annual, long service leave, sick, carers leave, and any other form of paid leave, or paid absences for public holidays. So during the reference period, this is one of the big questions we had originally was what happens if the employee was on leave for that period? Provided they were paid for it, those hours would then count. And then, so the reference period is pretty much just the 4 weeks for an employee that we're looking at when they worked those hours. So for an employee, it's the end of a 28-day pay cycle that finishes immediately before the 1st of March or the 1st of July. Now, this does not mean the 28 days immediately prior to the 1st of March or the 1st of July, because we're looking at full pay periods. So we're looking for 4 weeks fully completed prior to those dates, and we're looking at full pay cycles. So say, for example, an employee was paid on a fortnightly basis. We need 2 full fortnights completed prior to the 1st of March or the 1st of July. So it might be that those 2 fortnights finish on the 26th of February. So you've got to get them fully finished before those dates. There's no crossover for those ones. If the pay cycle for an employee is longer than 28 days, so for example, if employees are paid monthly, you have to pro-rata proportion of the total hours of work, paid leave, paid absences, for that one.
Okay, so I think that answers Gail's question in relation to the reference period. Just a question from Sandra about a not-for-profit. So if you receive a donation, would that be included in the turnover test?
Yes, on the date that it was actually received to you is when you include it for those purposes.
Yeah. Okay. So what if the standard reference period isn't reflective of what the employee would normally do?
Yeah. So I guess for a lot of people, the standard reference period is pretty much those 4 weeks in February. But I guess what do you do if, say, the employee had various types of unpaid leave? So they might have sick leave, they might have been on paid parental leave, they could have been volunteering in a bushfire zone, or they just might normally work more than the 80 hours. So this scenario comes in for when an employee in the standard reference period, so the total hours including work, paid leave, paid absences on a public holiday, was 1, less than 80 hours, and 2, when you compare it to earlier 28-day periods, that wasn't the norm of what the employee normally did. So say in November, December, January, the employee normally worked 100 hours in those 28 days, but then come February, they're on paid parental leave, so they didn't work. This is when we can actually fall back on this alternate test. So the reference period then becomes an earlier 28-day period, ending at the end of a normal pay cycle. It also requires the entity reasonably establishing the employee's usual hours over an established work pattern. So you can compare either single 28-day periods or an average of multiple 28-day periods. But pretty much this one, we're looking at, well, what happens if they normally work the 80 hours or more, but they haven't in the standard reference period.
Okay. So just to clarify, I know we talked about this a bit in our last webinar around when someone is an eligible employee. So when for JobKeeper 2.0, so for JobKeeper 1, it was the 1st of March, is that right? And
the 1st of March for most of it, and then at the start of August they extended the date to be that 1st of July. So that's those ones, and then both of those apply for JobKeeper 2.0. So all the original eligibility criteria that someone was, say, a permanent employee by the 1st of March or the 1st of July, or they had been a long-term casual for more than 12 months to those dates. Residency, all of those things still apply.
Yeah. So I think that's Pete's question. Yeah, I think that's answered 1st of July. And so Aggie asked a question around a new staff member started on the 22nd of June. Again, that was JobKeeper. So they will.
That's right. So provided that employee began on a permanent basis, so full-time, part-time, if they started on the 22nd of June, they would be in. If they were a casual that started on that date, they would not be in.
Yeah. So they were contracted for 30 hours a week. Obviously, in a hospitality business, so the hospitality business closed. But they were still contracted at the time whilst they were allowed to open.
So with this one, it's not what they were contracted to do. It's the actual hours that they were paid for in the 28-day period. And we'll actually go through an example of that one in a minute. So I might just hold fire on that because I'll go through it in a little bit of detail in a minute.
Okay, so what if the employee was not employed during all or part of the reference period? So this is this question, isn't it, around, or they started before the 1st of July, but their first pay cycle ended after the 1st of July.
That's right. So say, for example, someone started mid-February or mid-June. So we don't have a full 28 days pay cycles prior to those dates. So for this, we use a forward-looking test. So for pay cycles that are less than 28 days, so that's our weekly or fortnightly pay runs, the reference period is the first full pay cycle 28-day period ending on or after the 1st of March or the 1st of July that occurs, again, wholly during consecutive pay periods. So for, say someone did start on the 22nd of June, and say their first pay period began on the Tuesday, the 23rd of June. So we'd be looking for the 4 weeks from that date. So we'd be going the Tuesday starting the 23rd, we'd have Tuesday starting the 30th of June, then Tuesday the 7th of July, and then the 14th of July. So that's the first 4-week block that we've got closest to that 1st of July period. That's what their reference period would be.
Okay. So changing the topic slightly here. So what happens with the reference period for an employee when the business has changed hands or is transferred to another group?
Yeah. So examples of this, so say where the business has changed hands. So say I owned all of Blue Rock and Lisa was my employee. I've then sold the shares in Blue Rock across to Bruce. So Lisa's employment hasn't really changed. She's continued in that same entity. It's just the ownership that has changed. Another example where there's the change in the wholly owned group. So if I owned all of Blue Rock Accounting and Blue Rock Law and Lisa moved between those entities, this is also when this would kick in. So the reference period is limited to the time after the employee began either working under the new ownership or in the new entity. So it's the same test as the above one that we just went through. So for the pay cycles less than 28 days, so weekly or fortnightly, the alternate reference period is the first 28-day period ending on or after the 1st of March or the 1st July that occurs wholly during consecutive pay cycles. So if, for example, the shares changed over or Lisa changed entities on, say, the 3rd of July, we'd be looking at the next 28 days from the 3rd of July because we need to look when we're in that new structure.
Okay. So that covers the employees. How does it work for an eligible business participant?
So the test to determine which rate will apply will instead be based on the assessment of hours that the business participant was actively operating the business or undertaking specific tasks in business development and planning, regulatory compliance, or similar activities in an applicable reference period. Unfortunately, we don't have any further definition as to what those mean. That's as good as we've got for the moment. And then the reference period, so this is when we check how many hours they did, will be for the month of February 2020. So an eligible business participant must make a declaration in the approved form, again, don't know what that form is yet, to the entity that their total hours of active engagement were 80 hours or more. A sole trader must make the declaration in the approved form to the ATO that their hours of active engagement were 80 hours or more. So failure to provide those declarations mean that you'll default to the lower rate.
Okay, so what we're talking about here is that the director, the shareholder, the partnership, if it's a partnership, the partners. So just not the employees. So you can't, obviously you can only claim once. So you're the employees, you claim for the employees, you claim for yourselves as the owners in a different way. And it does include sole traders.
Yeah, it's just obviously a little bit harder to track. I mean, business owners would know they probably don't do timesheets. They probably don't pay themselves an hourly rate. They're working at all hours. So the best that they could come up with is that definition of being actively operating in the business for the 80 hours or more. And it's based on a self-declaration.
It's interesting that the date, that it's February. So the alternative reference periods, or is it just February 2020?
There's alternative ones. So the employees have got 28 days. The eligible business participants have got 29 days. So there's 3 scenarios when we can look at alternate reference periods. So if the first one is if the participants' total number of hours in February was not representative of what they would normally do. So this one kicks in if in February they did less than 80 hours, and when compared to an earlier 29-day period, all within a calendar month, was not representative of what they normally do. In that case, the comparison can be made to an earlier 29-day period, being any 29 days contained within a calendar month, and that the entities can reasonably establish the participants' usual hours over an established work pattern. So that's when, say for December, January, they did more than 80 hours. In February, they took a holiday. So we need to look back a bit further to see what they would normally do, as opposed to an abnormal month. The second scenario is when that eligible business participant commenced participation in February. So for that one, they might have become a director or an individual shareholder or a beneficiary of a trust, say mid-February. For them, the alternative reference period is 29 days starting on the date that the individual first began to satisfy the business participation requirement for an entity. And that one does not have to be contained within a calendar month. So if someone joined and became a director of an entity on the 23rd of February, we're going from the 23rd of February for the next 29 days, and that would be your relevant reference period to work out whether you did under or over the 80 hours. The third scenario is when the eligible business participant is in a business affected by a drought or other natural disaster. So say they were operating in a bushfire region and their business had been severely impacted. What they did in February is probably not what they normally would do. So in that case, the reference period would be the most recent 29-day period ending before the 1st of March 2020, during which the entity did conduct its business or some of its business in a declared drought zone or a declared natural disaster zone. So that one is one that does not have to be within the calendar month. We're just going back to find 29 consecutive days where they were not impacted by the bushfires or a drought.
Okay. So what are the administration requirements and how are reporting going to work during JobKeeper 2.0?
Yeah. So the existing forecast and actual monthly reporting requirements for the entities regarding turnover continue to apply. And in that monthly declaration, you will need to put which test you've met, whether that's the basic drop in turnover test or one of the alternative tests. The second one is the employer must notify the commissioner in the approved form as to whether the higher or the lower rate applies to the individuals. If the entity fails to let the commissioner know which rate the employee is meant to be on, unfortunately that employee then would not be qualifying for JobKeeper. So it's really important that we do that nomination. We expect that might be through their single touch payroll or through the monthly reporting. It might be that you mark which ones get the higher or lower one, but really important to do that. Entities, once they've done that, they've got 7 days to notify the employee whether that employee is getting the higher or lower rate. Yeah, so we're expecting there'll still be a few forms and that sort of thing to come out, but that's where it stands at the moment. Sorry, Bruce, you're on mute.
Just dealing with my dog barking in the background, but sorry about that. So just a couple of admin things. So the declarations to be supplied to the ATO, will they be via the JobKeeper declaration section?
So the declaration to the ATO, we're expecting that if we're talking about for the employees ones, yep. I'm expecting that'll be like a same with the single touch payroll that we've had to done to date, marking it in there. The alternative to that is when we're doing the monthly reporting, or whether there's an earlier one because it needs to be done in advance, is potentially an ATO report that we mark who gets the higher and who gets the lower, but I would expect probably through single touch payroll. In terms of the eligible business participants declaration, that one just needs to be provided to the entity, except for a sole trader because they're just providing it to themselves. And then I think it'll be part of the monthly reporting.
Okay. So an employee that normally works less than 80 hours, but works over 80 hours in the reference period, what happens then?
They get the over 80 hours.
Yep.
So you use that standard reference period unless it's not suitable. And when it's considered not suitable is that's not reflective of what someone would, or they would normally work more than that, not that they would normally work less than that.
Okay.
And with those, the alternative reference periods, it's only when it's not suitable. It's not, you can't use them just because you don't like the outcome of the standard one. But in that case, they'd actually get the benefit of the more than 80 hours one.
Just find a test that works. That's what you're trying to do. So what about this is a question from Tyrone here we haven't had for a little while, around employees that work for other employers. So if someone works more hours with another employer, but they're only getting JobKeeper from you, does the support, does it change now with JobKeeper too?
So the employee should only be receiving JobKeeper from their primary employer. So if they are a permanent employee of yours, then they can't be receiving it elsewhere. If they're casuals in a couple of places, they can pick and choose between those. But yeah.
But once you're in one, you're in that one.
Not necessarily.
Oh, you can change.
So it does come back to that 1 July date again. So if you're casuals moving around, it probably doesn't really work. But if you were a permanent employee and you did move employers, say you were originally in JobKeeper from the end of March and you finished with that employer the 1st of June, and on the 2nd of June you began with a new employer on a permanent basis, you can move your JobKeeper eligibility to that second employer.
Yeah. Okay. Last question before we go to Lisa. So someone works overtime in February, but they're not paid for that overtime until after the 1st of March. Is the overtime, does that count in the February?
Yes, so it's based on the hours that they're paid for. It's not based on the payment date.
Yeah.
Yeah.
Okay. Rosie, we might get Lisa. We might start on the legal questions for a little while, Joe, and I'll let you go and type some answers to the ones. So Lisa, obviously lots of changes in the amendments there for the nuts and bolts of how the scheme worked, and we did see some changes under the Fair Work Act a couple of weeks ago now. But so we'll go through some of those things now. So with the JobKeeper payments being extended till March, how has it impacted on the temporary JobKeeper provisions under the Fair Work Act?
Yeah, thanks, Bruce. So as you said, a couple of weeks ago, we had extensions to the temporary JobKeeper provisions in the Fair Work Act. And now this is divided the employers into two classes. The first is qualifying employers, and those are those people or the employers that still remain eligible for JobKeeper post 28th of September. And then we've got a category of what's known as a legacy employer. And those are the employers that originally participated in JobKeeper, but no longer meet the turnover test to re-qualify for the next quarter. So the condition with them, though, is you still need to demonstrate that you're suffering a decline of 10% in your turnover to be a legacy employer. So anything less than that, you're not going to be categorised as one of those two employers.
Okay. So let's go with the qualifying employer first. So those who remain eligible for JobKeeper after the 28th of September, what do the amendments to the Fair Work Act allow them to do?
So qualifying employers actually get the benefit of all the flexibility that is presently in the JobKeeper provisions, save for the annual leave request. So just by way of quick refresher for those out there, our JobKeeper powers were divided into JobKeeper enabling directions and JobKeeper requests. So your JobKeeper enabling directions was your stand down direction, where you could direct an employee to work fewer hours or days, including down to nil, where that employee couldn't be usefully employed due to impacts of COVID-19 or government incentives to slow down the transmission of the virus. And a second category to that was giving directions in relation to changing an employer's work duties or requesting that they work at an alternative location. So those were known as our JobKeeper enabling directions. We also had JobKeeper requests, and they involved requesting an employee to perform their work on different days and different hours. So keeping them on the same ordinary working week essentially as to the hours or days they do, but moving them. So for example, if they worked Monday to Wednesday, you could request that they work Thursday to Saturday, for example. And one of the ones that a lot of people did access, and I got a lot of questions about in a JobKeeper request, was the ability to request an employee take annual leave, provided that you leave them with a minimum of 2 weeks left over. So all of those provisions remain except that annual leave one. So if you have any employees that are taking leave post 27 September, so 28 onwards, when this scheme ends, that direction that you've given them can no longer apply. Obviously, if the employee genuinely wants to take annual leave, then that's absolutely fine.
Okay, so if you've given a JobKeeper request to an employee to take annual leave in September, and it extends past the 28th of September, what happens then?
Yeah, so that you'll need to then talk to the employee, because your direction will no longer be valid. You can no longer request that they take annual leave post that 28th September. But if the employee is actually really looking for some time off, or does want to take their time during that point of time, then that's absolutely fine. But that request that is available currently for the next few days really only applies for the next few days, and an employee can't unreasonably refuse to that request. But here, moving forward, they can, obviously.
Okay. And how does a qualifying employer give a JobKeeper enabling direction? Is it the same under 2.0 as it was originally?
Absolutely, exactly the same. So you have to give at least 3 days written notice of your JobKeeper enabling direction, except where there's genuine agreement for it to be a shorter period. You need to consult with the employee in relation to the direction that you're giving them, and you should keep a written record of the consultation that you've given. So all of that is good practice, but it is part of the legislation as well.
Okay. Jodie's asked a question around an employee. So the employee and the employer have a written agreement that after the 20th of September, due to the loss of income, that there'll be leave taken. It's still looking pretty tough. So the employee, and they've got more than 2 weeks leave, and they've got significant long service leave. I guess so what you're saying is the rules have changed, that even though the employee agreed to that previously, now they can say, no, I can go back to work after the 28th of September.
Yeah, so if you made that request to them under the JobKeeper provisions. So they were aware that it was a request made under these temporary JobKeeper amendments. Then you're going to have to go back to that employee and see whether they want to take their leave post 28th September onwards, because that is completely up to them. They can pull out of it if it was a JobKeeper request. But if it was a genuine consultation and they genuinely wanted to take time off, then that's a separate agreement. And that's like your standard, hey, I want some leave, and the employer allowing you to do so. So it's a different kettle of fish.
Okay. And so Rachel's got a question there. So if they have annual leave and long service leave, can they use up all the annual leave but keep the long service leave intact?
If the employee genuinely wants to do that, then that's fine.
Yeah. Okay. So in essence, it all remains the same for qualifying employers still eligible for JobKeeper except for annual leave provisions. What about legacy employers? How do these new rules apply to them?
Yeah, so legacy employers are in the same boat in relation to the annual leave provision, so they can no longer use this either. And then we move into the, they have access to all of the remaining provisions, except this JobKeeper enabling direction, stand down direction, which a lot of people use during this time, and I'm sure a lot of Victorian employers were wanting to use as well. If you're a legacy employer, that stand down direction can only reduce an employee's ordinary hours to a minimum of 60% as they were at the 1st of March of this year. So you can't, you've got to work out what their ordinary hours were. And so, for example, for a full-time employee, that's a standard 38-hour week. You can't then direct them to work anything less than 22.8 hours. So that's your 60% mark. In addition, the direction can't result in the employee working less than 2 consecutive hours in a day. So if they were a full-time employee, for example, you can't have them working Monday to Thursday full-time hours, for example, and then 1 hour on Friday. They need to have more than 2 hours in a single day.
Okay, so we're talking about legacy employers. So these are the ones that don't qualify for JobKeeper anymore. That's when the 60% rule applies.
So these are, yes, the ones that don't qualify for JobKeeper anymore, but can still demonstrate that they have a 10% turnover.
Okay. So how does a qualifying employer give a JobKeeper enabling stand down direction?
Yeah, so this 60% stand down requirement is slightly different to those who are qualifying employers. So the legacy employers now have to provide at least 7 days notice as opposed to the 3-day notice for qualifying employers. And they still have to tick the box in relation to consulting with the employee and taking a written record of that consultation as well. In addition, you're required to provide information to the employee or their representative about what you're proposing. Invite the employee to share their views and have a genuine, not perfunctory conversation about it. And give it, real regard and genuine consideration as to what the employee is expressing. So obviously with the legacy employers, there's slightly more focus on the genuineness of the consultation, which is really important across the board. But obviously for the JobKeeper 1.0, we saw a lot of businesses having to close, and you could give a direction so long as it was reasonable. Here, and probably a lot of people did it quite quickly. Here, the 7-day period and the extra requirements on how you're supposed to run your consultation do obviously stimulate a much more thorough discussion with the employee, and you have to take their concerns or inquiries on board.
Okay, so we're talking about the reducing hours and standing down. What about the wages of the employee? So under a JobKeeper enabling stand down direction, can you, under JobKeeper 2.0, can you reduce someone's wages now?
No, so that law hasn't changed. Their hourly base rate of pay must not be less than what they were previously earning had you not given them the JobKeeper stand down direction.
Okay. And for a legacy employer, they've got these powers under the Fair Work Act post the 28th of September. So what do they have to do to demonstrate that they've got these powers?
Yeah, so with legacy employers, they've divided it further again into two types of employers. You've got your small business legacy employer and effectively everyone else. So your small business is less than 15 employees. So once JobKeeper 2.0 commences, which is the 28th of September, and prior to the 27th of October, a legacy employer has to demonstrate this 10% decline in turnover by getting a certificate for the June 2020 quarter as compared to their June 19 quarter. And between 28 October and 27th of February, demonstrating their 10% decline is again a certificate, but for the September 2020 quarter as compared to the September 2019 quarter. And then again, they have to do it between the periods of 28 February and 29th March. Again, with the 10% decline certificate for the December 2020 quarter compared to the December 2019 quarter. I think Joe went through it, but the test is based on actual GST turnover as opposed to your projected GST turnover.
So the requirements for the 10% decline to get the turnover certificate, so what are they?
So if you're a small business, you can choose to make a statutory declaration if you wish, essentially saying that you've satisfied the 10% turnover test. If you are anyone else, and also a small business can do this, you get your turnover certificate from your accountant or your tax agent. So everyone can get it done by a professional, but you have that exception for small businesses who can go out and prepare a statutory declaration.
Right, yeah. So we'll move away from the JobKeeper scheme just for a minute. So what about employers that either they don't qualify JobKeeper or they're not a legacy employer, so they don't qualify for the rules going forward, or they've got employees that aren't part of the JobKeeper scheme? How do they manage their staff? Like what can they do?
Yeah, so unfortunately, we are going to get into a bit of a March scenario where we found a lot of people where we didn't have these JobKeeper powers, and we were giving advice to a lot of people about entering into discussions and consulting your employees and getting genuine agreement in relation to changes to employment conditions. So moving forward, if you don't qualify for JobKeeper as a legacy employer or qualifying employer, then you're really stepping back into consulting with your employees and seeing if you can get genuine agreement to changes in your workforce. Obviously, keeping in mind the minimum employment standards, wages and entitlements that the employee is entitled to. You can't dip below that. We do have the stand down, I call it the general stand down provision, but this is the one that's been in the Fair Work Act prior to JobKeeper. So this is the one that a lot of people were relying on back in March that we're going to probably see in Victoria in particular a bit of a focus on, where you can stand down your employees where they cannot be usefully employed to work for circumstances that are beyond your reasonable control. So obviously where the government has implemented restrictions on you operating your business, and that impacts on whether you can open or how you open, then a stand down may be applicable to you.
Okay, so this applies for businesses that may have all of their staff under JobKeeper, but they have one or two that don't qualify as well for the particular employees.
Correct. So it might be, for example, I'll take Victoria because we're in stage 4 lockdown here. So if your business has been closed because of stage 4 lockdown, if you were qualified for JobKeeper, you would have given a JobKeeper enabling direction to reduce everybody's hours to nil. For those employees that didn't qualify, those who weren't eligible employees, you would have given potentially a stand down direction to them just under the Fair Work Act.
Okay. So how do the stand down provisions and the award changes differ from these JobKeeper provisions?
Yeah, so the stand down provisions in the Fair Work Act are different from the ones. So there's two stand down directions actually in the Fair Work Act. And they are one which is related to JobKeeper and the other which is not. So if you are a legacy employer, obviously you can only stand down to 60% of the ordinary hours and must have 2 hours, 2 or more hours consecutively in a day. For qualifying employers, obviously you can stand down to nil. So that's in one bucket. And then if you don't qualify for either of those, you can stand down under the general stand down provisions in the Fair Work Act. However, you need to demonstrate that your employees cannot be usefully employed by you for circumstances beyond your reasonable control. So there is more of an onus on you in relation to the general stand down to get it right. If you don't get it right, then you might find employees knocking on your door saying you shouldn't have stood me down and putting their hands out for lost wages for those days.
Rightio. So you're an employer and you need to terminate one of your staff whilst they're on JobKeeper. Is that possible?
It is possible. So you can still terminate on JobKeeper. It's unfortunately a grim reality. It should be your last resort. But we have found that unfortunately some businesses need to do that. And if you see the news, you can tell that that's happening. If you do make them redundant, you need to follow the ordinary processes in terminating them, and that includes your consultation, the rates of pay and entitlements that you pay out on redundancy, including the termination notice, leave and redundancy pay if that's applicable to your business. And bearing in mind, if you've given a JobKeeper enabling stand down direction, the wage that they would have been on pre you doing that is what applies here.
Okay, so we can terminate them, sorry, just to be clear, so if we can terminate them for poor performance rather than redundancy.
So that's a separate matter. So that's one's associated with potentially business turnover or restructure, and the other is associated with underperformance.
Okay, so poor performance, you can terminate them as you normally would.
Yes, following the obviously the guidelines of consulting, performance management, those kind of things. Training.
Okay, and so you can make an employee redundant. So what sort of steps do you need to go through for redundancy in the current environment?
Yeah, so it's really important to consult with your employee. So first step is you make a definitive decision moving forward. You consult with the employee, you have a genuine conversation with the employee, listen to what the employee has to say. You have to offer a support person to these consultation meetings. You also have to consider redeployment options, both within your own organisation and in your associated entities. And if there is no redeployment options, you've got to let the employee know. And then following those discussions, a termination notice it needs to be given to the employee.
Thank you very much, Lisa. Thank you, Joe. And thank you to everyone who joined today. We're right on 2 o'clock. So I think if anyone else has any questions, please feel free to email us. We'll send an email out with a recording of this session if you happen to jump off different times or you'd like someone else in your organisation to watch it. We'll send that out shortly. But thanks again to everyone for joining our webinar series and learning all about JobKeeper. Stay safe and look forward to seeing you soon. Thanks.